Welcome to the deep dive. Today we're focusing on something that's really at the heart of financial decision making. CVP analysis, cost, volume, profit.
And its close cousin, operating leverage.
Exactly. And look, if you manage a budget, if you run a business, or even if you just want to understand the financial health of a company, CVP is, well, it's a non-negotiable tool.
It really is.
And we're not just going to run through definitions today. We want to dig into the strategy here. We're going to unpack how a company's sales, its costs, and its profits all connect.
That's right. Because CVP isn't just about will we make money, it's the blueprint that helps you predict profitability and, maybe more importantly, assess the structural risk of your entire business model.
So let's start with those core components. CVP analysis really boils down to four key factors. The first two are what you could call the volume-driven ones. First, you've got sales revenue, and that's pretty straightforward. It's a function of how many units you sell, your price, and of course the mix of products you're selling. And running right alongside that, you have your variable costs. Think raw materials, direct labor costs that move in lockstep with your volume.
And they're also dependent on that same product mix.
Exactly. Then you get to the bedrock, right? The strategic part, fixed costs.
Yes. This is where management really places its bets. A fixed cost depends on choices about, capacity, infrastructure. It stays the same in total whether you make one thing or 1,000 things.
Within a certain range.
In the relevant range, yes. And finally, you get profit, which is simply what's left over. Revenue minus variable minus fixed. But the real trick here is understanding how these costs behave. It's often counterintuitive.
It really is. This is where I think a lot of people get tripped up.
Absolutely. You have to separate the idea of the total cost from the cost per unit.
Okay, so let's break that down. Variable cost.
So a variable cost is variable in total. The more you sell, the higher your total variable expense. But, and this is the key, it's fixed per unit. The materials for your 100th widget cost the same as for your first one. That $5 is constant.
And the reverse is true for fixed costs. This is the whole magic of economies of scale, isn't it?
Precisely. Fixed cost is fixed in total. Your factory rent is what it is, but it is highly variable per unit.
Right.
If your rent is $10,000 and you sell 100 units, each one has to carry $100 of that rent. But if you sell 1,000 units, suddenly each one only carries $10. That's how profit explodes once you pass your break-even point.
That distinction is so critical. But, business is never that clean. You don't just have two neat cost buckets. What about the hybrid costs?
Yeah, the hybrids. They add a necessary layer of complexity. You often run into what we call stepped costs.
So that's like needing to hire a new supervisor once you hit a certain production level.
Exactly. It's fixed for a range, and then it jumps up. And as a manager, you have to make a call. If the steps are really wide, you can probably treat it as fixed. If they're small and frequent, you might just approximate it as a variable cost to keep the model simple.
And then there's the other type, mixed costs.
Mixed costs. Your classic utility bill, right? A fixed service fee every month, plus a charge for how much you actually use.
So it's got both components.
It does. And before you can use a mixed cost in any CVP model, you absolutely have to split it into its fixed and variable parts.
And how you do that split, that can totally change your predictions, can it?
Oh, massively. There are a couple of common methods. One is the scatter graph method. You plot all your data points and visually draw a line through them.
This is more of a visual gut check approach.
It is, and that's its strength. You can actually see if the relationship looks linear or if you have some wild outliers that are messing things up.
But the other method, the high-low method, that one's purely mathematical.
It is. It's fast and simple. You just take your highest activity point and your lowest activity point and calculate the variable rate from those two. But it's so risky.
What's that?
Because your highest and lowest points are often the weird ones, the outliers. Maybe a machine broke down one month, or you had a massive one-off order the other. If you base your entire cost structure on 2 points that aren't representative, every single calculation you make after that will be wrong.
So the lesson is, simple is not always better.
Especially not here.
Okay, so once we've got our cost architecture sorted out, we can start crunching the numbers. Let's talk about the real engine of this whole thing, the contribution margin.
Right, CM. It's the lifeblood. It's simply your sailed revenue minus all your variable costs.
So it's the cash that's left over from each sale.
That's available to contribute to covering your big pile of fixed costs and then hopefully generating profit.
And that leads right into the main formula, the target income equation, which is just sales minus variable costs minus fixed costs equals your target income.
And the most important target, at least at first, is zero. When your target income is 0, that's your break-even point. That's the bar you have to clear just to survive.
It's the minimum.
The absolute minimum. And from there, we can get this really powerful metric, the contribution margin ratio. That's just your total CM divided by your total sales.
And that's so useful for quick what-if scenarios, right?
It's incredibly powerful. Take that Stella Signs example we looked at. Their CM ratio was 53%. That means the manager knows that for every additional $10,000 in sales they generate, 5,300 of it drops straight down to help cover fixed costs or become profit. No need to recalculate everything.
That's a huge shortcut. It must also tie into assessing risk, maybe something like a margin of safety.
Absolutely. The margin of safety is just, it's your cushion. It's the difference between what you expect to sell and what you need to sell to break even.
So a big margin means you can handle a bad month or a downturn in the economy.
Exactly. A company with a thin margin is walking a tightrope. Any little dip in sales, and they're suddenly losing money.
But what if you're not just trying to avoid losses? What if you have a specific profit goal in mind?
Well, now you're talking about target costing. You work backwards. You say, okay, we need to make $500,000 in profit this quarter. You add that to your fixed costs. That total is the contribution margin you must generate.
And then you just use that CM ratio to figure out the total sales dollars you need to hit.
You've got it. It turns the model from a predictive tool into a planning tool.
Now, this all sounds great for a company that sells one thing, but what happens when you have a whole catalog of products?
That's where it gets tricky. For a multi-product firm, a single CVP calculation breaks down because your overall CM ratio is now a weighted average. It's not constant.
So what do you need?
To find the break-even point in units, you need 3 things. You need your total fixed cost, that's a given. You need the contribution margin for each product. And, this is the one people forget, you absolutely must know your sales mix.
Okay, so let's define that. What exactly is the sales mix?
It's just the relative proportion of the different products you sell. You know, for every 10 items you sell, maybe 7 are product A and 3 are product B. That's your mix.
And why is that so critical?
Because not all sales dollars are created equal. If product A has a fantastic contribution margin and product B has a terrible one, your overall company profit is incredibly sensitive to any shift in what customers are buying.
So the strategy isn't just sell more stuff, it's sell more of the right stuff.
That's it in a nutshell. You want to push the products with the highest individual contribution margin ratios.
Like in that Jones Company example we saw.
Exactly. They sold Jumbo and Standard. Jumbo had a 60% CM ratio and Standard only had 30. Every dollar from a Jumbo sale was literally twice as valuable to the bottom line.
So the clear action item for a manager at Jones is to put your advertising budget, your best sales commissions, your prime shelf space,
all behind Jumbo. You're working smarter, not just harder, to increase the contribution margin you get from every single sale.
That shift from tactical profit to a more structural view of risk brings us perfectly to operating leverage.
Yes. OL is all about the fundamental financial DNA of a company. It's about that trade-off, fixed costs versus variable costs.
And there are basically 2 types of structures you can have.
Right. On one hand, you have high operating leverage. This means high fixed costs and low variable costs. Think of a big automated factory or a software company. It's an aggressive structure.
Any other.
Low operating leverage. Low fixed costs, but higher variable costs. This would be a business that relies on contract labor or outsourcing. It's a more conservative, flexible model.
And the risk profile for these 2 is just night and day because of what you call the amplification effect.
That's the whole game right there. Operating leverage is a financial amplifier. The higher your leverage, meaning the more fixed costs you have, the more sensitive your profits are to any change in sales.
So let's talk about the upside first.
The upside is huge. For a high-leverage company, once you get past your break-even point, profits grow incredibly fast. You've already paid for that big factory, so almost every dollar from the next sale, minus a tiny variable cost, goes straight to profit.
But that amplifier works both ways. The downside is just as dramatic.
Absolutely. Below the break-even point, that same high-leverage company will see massive losses. Sales can drop, but you still have to pay for the factory, the machinery, the salaried staff. Those fixed costs just crush you when revenue is low.
Which, again, reinforces why that margin of safety is so vital for high-leverage companies. You need that buffer.
You have to have it. It's about resilience. If you're running an airline, you have no choice but to have high operating leverage. So you better be good at forecasting demand and maintaining that safety margin.
Now, we can't draw it for you here, but these relationships are often shown on a CVP graph. What's the real insight you get from visualizing it?
Well, everyone focuses on where the lines cross the break-even point, but I think the real story is the angle between the total revenue line and the total cost line after that point.
What does the angle tell you?
A wide angle means you have a high contribution margin ratio. Profits are accumulating rapidly. A very narrow angle means your CM ratio is low and you need a huge increase in volume to make any real money. It shows you the profit potential of the business model itself.
But this entire framework, this whole model, it rests on some big assumptions.
It does. And if those assumptions are violated, the model falls apart. The biggest one is linearity.
Meaning we assume everything is a straight line.
Exactly. We assume the selling price per unit is always the same, and the variable cost per unit is always the same. But in the real world, you offer volume discounts. Your suppliers give you price breaks on materials if you buy in bulk.
So those straight lines are really curves.
They often are. And when that happens, a manager has to be smart enough to either use a more complex model or, at the very least, create different linear models for different ranges of activity. You can't just blindly trust the one simple CVP calculation.
This has been a fantastic deep dive. We've really moved from just defining terms to seeing how CVP is the framework for finding your profit threshold and how your cost structure, your operating leverage, really defines the financial risk you're taking on.
And the takeaway for you listening is that this knowledge is only powerful if you apply it with a critical eye. Always question the assumptions in your model, and strategically think about how you can use your resources to shift your sales mix toward those high contribution products.
A great summary. And you've got one final thought for us to mull over.
I do. Thinking about that amplification effect of operating leverage, how would a huge established company like a major airline or a telecom provider with massive infrastructure costs, how do they manage the insane risk of their high operating leverage? How is their strategy different from a startup service business that has almost no fixed costs? What tools beyond CVP do they need to survive a downturn? That's something to think about.